Hello, welcome back to WinFS Trading YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. In today's video, I'm going to introduce you to AP risk money management subject to valid price action rate of change. If this is your first time of visiting this channel, try your best to subscribe and turn on the bell notification so you get notified each time I upload a new content, and try to refer this channel to your network, and also like and recommend this channel to your network so that YouTube push us to a high level of audience. Okay, there is not much time to waste, so we're gonna dive into the main subject of this video content. This topic gonna change a lot of people's life, but this is a patron based content, meaning that after 1 week of release, as soon as possible, the video will be privatized, and for you to actually keep watching this video, that means you have to subscribe to Patreon or become a Patreon subscriber for you to keep watching this video. So I will start with the document description, and then we go to the MT5 chart for application. Validity of a signal suffered near failure probability than success probability. Validity of a signal suffered, we can use present continuous so that this makes more reasonable sense. So validity of a signal suffers near failure probability than success probability. The smart money like brokers or well traders have higher statistical edge over traders. Even smart money traders have edge over each other, like JP Morgan trading against um, the Goldman Sachs. So if JP Morgan is longing and Goldman Sachs is shorting, and overall market direction is actually longing, Goldman Sachs will lose money. So you can see that JP Morgan have statistical edge, or even the BlackRock, they can actually have statistical edge over another. Okay, so that's why I'm introducing this topic, because of the differences in statistical edge. Not that the prediction you made is not going to work in your favor. Definitely it's going to work, but after a lot of drawdown or some compromise. So as a result, one need to serialize percentage risk level for a given trading session. The reason for this is, this is gonna be changed to singular. Is the reason for this is that a buy signal can actually become a sell signal and vice versa. A valid signal can have drawdown that need SL shift and opportunity. Like a valid signal can have drawdown that need SL shift and opportunity to add more positions. Also, a signal with zero drawdown and maintain certain percentage profit level create more opportunity, saturation retracement point to add more positions. Like if you place a trade and it's actually giving you profit, a time will come when there will be a saturation retracement, or a kind of retracement that saturates at certain point, so that you can add more position in the current direction, in the main direction of the market. This variation signal validity or success, this variation signal validity slash success failure probability density space function lead to shift in the SL or SL pips. Like the signal validity or the success failure probability density space function of a signal lead to shift in stop loss or SL pip. In other words, practically or manually, you are going to be moving your stop losses. You can move it in an increasing manner whereby the stop loss pip increases, or you can move it in a decreasing manner whereby the stop loss pip also reduces. Okay, so this variation lead to fall and rise in overall risk level. This variation lead to fall and rise in overall percentage risk level. To avoid putting your total risk in one basket, we need to serialize total risk using arithmetical progression AP. The sum of the AP must be equal to the total risk you accommodate per trading signal. Typical AP on 10% total risk per trading signal can be generated using the following equations. Sn is equals to n over 2 upon bracket open 2a plus n minus 1 bracket open and close d bracket closes. An is a plus n minus 1 onto a bracket and then closed by d, where n is equals to maximum number of times which represent the maximum number of drawdowns or trading opportunities. We set n to 3. A is equals to first time, which represent the first risk level. D is equals to common difference. We set D to 1%. To start serialization, we must know the following: Sn and D. With these variables, we can compute the A and hence the AP that represent the discrete risk level per opportunity. The discrete risk level per opportunity. AP. So the AP will be equals to, like is calculated as follows: 10 is equals to 3 divided by 2 upon 2A plus 2D. When you run the calculation, the A will be equals to 2.33%. So our AP discrete level is 2.33%, comma 3.33%, comma 4.33%. If you sum these series, you are going to get 10%. So the bigger the n, the lower the first term. Very small n will be applicable in low risk environment, while very big n will be used in high risk environment. Types of AP risks. Forward risk. These risks are implemented in ascending order. This is applicable in high risk environment. So an example of forward risk is AP 2.33 slash 3.33 slash 4.33, all in percentages. Okay, these are percentage values, not just kind of odd levels. Backward risk. These risks are implemented in descending order. That just opposite of forward risk. This is applicable in a low risk environment. Example is 4.3, 3.3, 33, 2.33%. Okay. If you have a signal that you believe that this signal is less risky, you can start with this. I think you can apply the backward risk, the AP backward risk method. Now you will be thinking that this is not very, very serious. This is very serious when I take you to chart and you will see how you would have applied this to succeed in your trading. And let's go to chart and start practicals here. Okay, this is good in the H4 time frame. The major thing is to run your top-down analysis and obtain the major direction of the market. You must know the main direction of the market because there are a lot of directions in markets. Some are short-lived, some are long term. So you should be looking for long-term direction of the market. And how you can do this is to do the top-down analysis from the monthly all the way down to the 1 minute time frame. You can see that this is a very strong demand zone because immediately price reach there, we experience a massive buy all the way from here to this price. So when price tap into this demand zone, we expect another buy. So when you now go to when you go to the daily time frame, you will notice that there is a kind of range. There was a kind of compressions or a kind of range and loss of momentum as the price approaches inside the zone. It started creating ranging candles. These are doji cross, about 3 doji crosses, and suddenly we have a hammer, a bullish hammer that closes above the open of those doji crosses, and that is a sign of bull run, like buy signal. Now, if you want to apply this idea, you can now start by saying that you are not sure if this level will hold price. Since you are not sure that this level will hold price, we can say that this is both high risk and low risk because there is no break of structure yet. It is assumed that you are not clear of if the signal is ready, but you are sure that it will happen. But the readiness of the signal or the actual time it will start, you are not sure. So you are entering this trade here, you might be having issue that the drawdown will continue maybe below towards this price before it will shoot. The liquidity grab or sweep can happen. And so in order to solve this problem, you now need to run your stop loss analysis. So you want to place your stop loss below this line. Yes, you are placing your stop loss below this line now, and is your first entry will be um, your first entry will be here. You are entering somewhere here at this price 1840, and when you look at your maximum stop loss level, that will be 83 pips. Okay. In this video, one the pip value of goods is $100. Some other uh creator we call it $10, but I use $100 because that is my own parameter, and you have to be consistent if you are my subscriber. The reason why I use $100 is because I actually measure the pip with the coordinate reading. Some people can call this 83 pips as 830 pips, and then their p value will be $10, but I just give you the actual value. That is my criteria on good. So it is 81 pip with a pip value of $100. Okay, so this is my highest stop loss. So every trade I'm placing, I'm sorry, the first trade I'm placing, or the first few trade I'm going to be placing based on the AP risk, will be like they will be referred to this stop loss. But that does not mean that this stop loss is fixed. The stop loss is not fixed based on AP. This stop loss that is here can be moved. When I notice that price is ready to move in a given direction, then the stop loss can be moved, and maybe it can be brought to this price, and then any other position I'm going to be adding will be referred to this stop loss, and then you can see that there will be gain in our loss sizes. I will show you why. Let me go to documents and add the formula to calculate loss size so that you know what I mean. Okay, this is how you can calculate the loss size. Very important. This loss size equation is necessary in this AP risk application. So total loss size is total risk upon APT divided by the stop loss P upon P value. The loss size per position will be equal to total loss size of a number of positions you want to open. The P value of forex asset varies and will be specified, but P value of synthetic asset is $1 except for step index that has $10 per P. Okay. So what I want you to consider here is the position of the stop loss P. You see, the more, assuming every other thing is constant, the more you lower the stop loss P, the bigger the loss size, and the more you increase the stop loss P, the lower the loss size. Okay, so if we shift our stop loss to a lower value, like if we reduce stop loss P, then we will expect high loss size or big loss size. Then if we increase the stop loss P, we expect small loss size. The truth is that this will be based on the risk level you are going to be using as well. You can see there is a percentage risk. So you are going to replace this total risk with the discrete risk that you are applying. Okay. I'm going to give you an example on the chart once again. So let's go back to the right now we're on the chart, and now you want to enter this market here, but you're afraid. What if I enter here and they start going down to create lower lows? And as a result of that, we give it enough room to breathe. Like we allow our stop loss to be big so that we can be able to allow this market to do whatever it want to do before going to our direction, because we know it will. So this is around 84 pip, and I'm gonna take you to calculator for the first position, because we are going to use, because of this is a kind of it has some element of high risk and low risk, right? Because we are sure that this signal gonna happen, so we might be using a kind of forward risk method. Yes, because of that high risk it has. Because it hasn't created liquidity below the support. If it has created liquidity below the support, then we say that it only have a low risk. But because that liquidity might happen, so it's a high risk, and we shall be using a forward risk method. So to for this, we are going to be risking total of 10%. Okay, and going back to for forward risk, the first term in the risk level or discrete risk should be 2.33%. So I'm going to use two. Now we have a $200 account, so we are going to multiply by 2.33%, and that will give us $4.66. Okay, on a $200 account. So here we are going to work, like divide this by the peak level, which is 84, multiplied by the peak value, which is what, $100. So we shall be having 0.0005. Now you see that a broker will not allow you to use this loss side. What we need to do now is to increase our equity to $500. At least if you want to make money in forex, like you need to have enough equity, right? So let's increase it to $500, and then we can still not use it because this is giving us 0.001. So let's increase it to $1,000. When we increase it to $1,000, you can see that we can still not use it. So let's increase it to $5,000. With $5,000 account, you see, this topic is for big men, like it's for big investors, people that are rich and want to be rich more. So my idea is not just for people that just want to make money, without having enough money. You need big money for you to make this money, for this thing to work for you. So $5,000 account, you will be using 0.1 lot size. Okay, if you approximate this, you're gonna be 0.1 lot size. So what you need to do is to come here and do what? Open a trade here with what? One lot size. You can see that I'm calculating my with 0.01 lot size. You can see that I'm calculating my like the stop loss PP is being calculated at higher time frame. The reason why is that I don't want to lose this trade. Like, I'm not taking a trade that we lose. It's just that there will be some drawdown or some opportunity, but at the end I will succeed. That's why you can see that the loss size is small, but then this is gonna work, because you can see that we were able to generate around 165 pip. Okay, this makes sense. This become reasonable when you have large equity. Okay, so I will now show you how our position will start increasing in profit, like we will start having bigger lot size, because there is a break of structure now. We now know where the market is heading to. There is a break of structure, and then we have this bullish candle. Then we can now move our SL to this level. Immediately we move our SL to this level, the pip level become, the SLP become 50 pips. The SLP become 50 pips. Okay. Then we can, when we know where the market is heading to, we can go further to lower time frame like H1. When we go to H1, you notice that um there is a break of this structure, and price can never enter inside this structure. So if we are entering trade here, we can place our stop loss somewhere here. We can now see that the stop loss peak has fallen to 31 peak. Okay, we now have we now have 31 peak to work with. So this time around, we are now going to add another position. This is where we are going to be making more profit. Like, this is where the actual trading will start. We are now going to add another position, but the risk level we are now going to use is what? Let's go to document. Remember, we are using the forward risk method. So the next risk level will be 3.33%. Okay, now let's go. We are now going to apply 3.33% on we're now going to apply this on $5,000 account. You don't need to actually use your equity. No, you use your balance. So 5,000 the deposit. So here we are now risking $166. So $166 divided by 31 pip by $100. So you can see that our lot size have increased to 0.05. We are now going to add 0.05. When we add this 0.05, we're actually adding it around this price, right? Now, but we are after adding it, we still want to prove that, like, we still want to believe that this market will break a new level and retest. So this is an opportunity. This is what we call opportunity. It's not a drawdown. A drawdown will be when it failed to break this structure in the daily time frame. It failed to break this structure here that I covered with this lab, and then start drawing down below the support level here. So that is a drawdown. You will still add, you see, when that thing happen, when the drawdown happen like that in the daily time frame, you see, this thing is a professional stuff. If the drawdown happen in the daily time frame, okay, if it happen in the daily time frame, what you need to do is to add like to confirm where the stop loss will be first, and then you add a new position. Let's assume it draw down to here, or to near where you put your stop loss. Then you move that stop loss to here, okay, and then you calculate the stop loss pip, which will be around 54 pips, and then you add the position accordingly. You see, this idea, like, it will, most time the total percentage risk will go beyond 10%. The reason why it will go beyond the 10% is because of the stop loss people will be varying, and most time it will be big, most time it will be smaller. Most time you will get a total risk level less than 10% or bigger than 10%. Like when you recalculate the actual risk, when you remove the errors, you see error of measurement and all of that, you see. Now we go back to 1 hour time frame. When you have done this, you see that we are now adding a new position here. We are now adding a new position somewhere here. So this new position we are going to add, we are going to use 4.33% as the risk level, and the question now is, what will be the stop loss? When we know that this market is progressive, the stop loss will change for this position. It will still be the same stop loss, but you will change the stop loss people. What I mean is that now that we have known where this market is going, and all stop losses is somewhere here, you want to add a new position here. You are not going to just measure the stop loss pip to be at 5 or something like that. No, rather you are going to measure it with respect to previous swing. So you are not going to be using 15 pip. You see, on overall, your risk level can go to 20%, but we are doing this to avoid over risking. Okay. Right now, we are going to use 15 pip. You will see that the lot size will be increasing at this moment. So you are going to use 4.33% as your series, and you apply it on the same $5,000 account. So you'll be risking $216. $216, and then you are going to be dividing it by $100, and then by the this time you see, the stop loss peep have to be a variable. It have to, most time it will even reach one peep. We are making it to be a variable so that the actual risk will go either, most time the total risk will go, it will definitely go beyond 10%. The reason why it will definitely go beyond 10% is because of there are errors you are introducing in your risk level. you're actually putting your stop loss at the same level after you confirm that the direction is this, is going in a given direction, and then you will now readjust your stop loss. Then the stop loss pips you are going to be using based on the AP risk is going to depend on the swinging. Your entry is going, the stop loss will be from where you enter to a previous swing. That is, as you see how I did it in the chart. Okay, so I'm going to give more example. So you are going to multiply by 15 pips because this is the stop loss pip now. Even though our stop loss is not like the stop loss is not changing, but the stop loss pip is changing. Okay, so here we are not going to be using 0.14 loss size. Okay, we are not going to use 0.14 loss size, and this could be the last loss size we are going to be using. So we are going to lump more positions here. Okay, we can lump more like this time around the risk will increase, the total risk will increase. It might reach 20%, but you must have a trading plan. You shouldn't risk, you should have a maximum risk apart from the base risk you started with. You can say, okay, I shouldn't risk more than 20% overall or 30% overall, because you know that if you risk 100% and the market go against you, you will lose the $5,000. But if you have a maximum risk level of 30%, you will lose. If you lose the 30%, you still have 70% to hold on to. Okay, that is the idea. um so you can see how this market is moving and keep moving. This method is for swingers. It's not just for scalper, or it's not for scalper or day traders. You have to be a swinger, somebody that can hold a trade up to a month or more than a week, more than 1 week, more than 1 month, more than several days. Okay, we can see this trade keep running for how many days? Keep running for how many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. About uh, close to 3 weeks. That is more than uh, close to 1 month. Is actually going close to 1 month, and there is high chances that gold will actually come and hit the previous high. It will happen because you can see that is actually upward, it's uptrend, so it will have actually broken the retracement loop. This is a retracement loop, so it's heading to 2072. Gold is heading to 2072. The same way GBP USD will be heading to bigger prices or higher prices. So because gold, most time gold and GBP USD or any currency that end with USD, most of them, like, they move in the same direction as gold. Okay, most time, but there is no guarantee it will all the time, but most time, maybe let's call it 60% of the time they move in the same direction. I'll be ending this video. This video is an advanced video, which means I'll be giving more updates only to patrons, bringing more highlights on this content and reviewing it and adding new things and removing the ones that are not necessary. So you have to become a patron for you to have access to that, because I'm gonna privatize this video after 1 week of release. So you just watch it once and you may not have access to it again. It's because these are deep idea that are secret to me, and I'm just bringing it, so you don't need to expect me to keep it for a long time on YouTube or public YouTube channels. Okay, thank you, and keep coming to this channel.